Maybe we can give 2 minutes to the others to join.
Do you hear my voice?
Yes, we can.
Shall I have to go on?
Maybe we can wait 2 minutes for the others to join. I think there are some students.
Okay. How was your holiday?
It was nice. How about you?
Very hot. Okay. I have uploaded some assignments for the other class. I think you don't need this for this class, isn't it? You are satisfied with the results.
I can hear you, sir.
Do you want me to upload any assignment for upgrading your results, or is okay?
Is it for upgrading our midterm exams?
Yes, yes, related to the midterms, yes.
Okay, I think I can use one.
You are satisfied, I think, isn't it? You got a good result.
No, I'm not satisfied.
You want some,
I'm not satisfied.
you want some upgradings, you want some assignments.
Yes, sir. Upgrade my result for midterm.
I may upload one assignment for you. For those who want to upgrade the results, will then attend and to do, okay?
Okay, sir.
You
Thank
have
you.
some 10 days time to do and send to me. Due time maybe end of May, maybe. I don't know if it is okay. Okay, I will start the class if you don't have any question. I think you don't have any question. I have to start the class.
Okay, sir.
Okay, today we are going to the monetary
I
system.
can hear you.
Do you have any question? Okay, we are going to the chapter 29. The monetary system will be introduced to you, the so-called the central bank applications, the tools of the central banks, the monetary tools of the central banks. We are going to concentrate to the money market, so-called the central bank applications, as I mentioned to you, the open market operations, discount rate, reserve ratio, how it is affecting and changing the amount of the money in the system will be introduced to you in this lecture. And some information about the money, how it is affecting and enlarging the capital is going to be introduced to you in this class. As you know, money before the paper banknote that we are using in the system, the currency, it was the barter system. I don't know if you ever heard, there were some exchanging some goods and some other produced articles in the market would be enough for trading goods. But after a period of time, they are using different kind of materials such as shells, seashells, and some tobaccos for exchanging the goods. And then the currency come to the market, and we are questioning from this point of view how this money market is affecting and changing the economy, because you are understanding money is not a instinctive capital, is not a instinctive paper. It is given itself the value by the others. And when you are seeing piece of paper, probably is not valued, but when it is a money, when it is a printed money, it is valued. From this point of view, when we are defining the money, money is the set of assets in an economy that people regularly use to buy goods and services from other people. The functions of the money is three different functions observed in the economy. The first one is the medium of exchange. The other one is the unit of account, and the third one is to store value. The medium of exchange, as you are understanding from the words, the medium of exchange is an item that buyers give to sellers when they want to purchase goods and services. And medium of exchange is anything that is readily accepted as payment. And unit of account is the yardstick people use to post prices and record debts. And store value is the item that people can use to transfer purchasing power from the present to the future. And from this point of view, money probably the only currency, only the value that we can put to the bank to get in future some more valued, as you are understanding from the interest is subjected here. And when you are putting some capital to the banking system or buying such valued papers, stock papers, bonds, will be then evaluated and valued in the future. Therefore, from this point of view, store value becoming very important in the economy. And you may deliver it to the future or you may use it in the present. As you remember, we have analyzed the present value and future value from this point of view, and we question the economy carefully, whether it is better to use the currency in the present value or we are letting it to use in the future value, and we are estimating its let's say interest, its capital, which is going to be delivered in the maturity date, and this will then evaluate from this point of view. And as you are remembering, the present value and future value becomes very important in the economy because you are then determining to finance your capital in present or you may deliver it to the future. And the functions of money, as you remembered from these three functions, exchanging of the goods and services, store value, and as I have mentioned to you, the unit account, which is giving the value of everything. We then determine the value of every produced goods and services regarding to this currency. And these are very important in the economy because it is affecting and changing the market structure by increasing and enlarging or decreasing and reducing the amount of this money in the economy. And from this point of view, we are coming to the liquidity, which is important in economy because as much as you are understanding, the amount of the liquidity in the system is either enlarging and increasing the economy and reducing its value, or if it is less in the economy, it is decreasing its amount, but it is increasing its value. And you probably estimated the depreciation and appreciation of the currency from this capacity of the liquidity. If the amount of the liquidity in the system, if the money in the circulation is much, then it is depreciated. And if it is less in the money in the circulation, then this will then increase and appreciate its value. And from this point of view, liquidity is becoming very important for the economy. As it is defined here, it is the ease with which an asset can be converted into the economy as a medium of exchange, because we are using many things for transferring the capital from one to another, or from institution to institution, or from country to country, results of this property. Commodity money takes the form of a commodity with instinctive value. As you are understanding, the gold, silver, cigarettes has its instinctive value in itself because gold is a very rarely founded material as silver, and some cigarettes is also, tobacco is also either is going to be produced by people or is not valued. And the money is not like this. It is not instinctive because you give this value to the money because it is only a piece of paper, and you put some shapes, some figures, and some printed marks on it, and it will then becomes appreciated. One paper becomes $5, one paper becomes $100. Therefore, you give this instinctive value to the paper. And it does not have its instinctive value, as I mentioned to you, as coins, currency, and some other deposits that we are delivering. You sign the paper and it will become important for somebody because you become dependent, or you buy some bonds from the market and it is written on the paper that you will get 30% interest at the end of the period, and this will then brings you a value. Therefore, you pay something for this paper, piece of paper. From this point of view, you are understanding alone a paper is not valued, but then when you are doing some procedures and doing some signatures and adding some marks and printing value, then it becomes appreciated. The currency is the paper, bills, and coins in the hands of the public, and demand deposits are balanced in bank accounts that depositors can access on demand by writing a check. And as you are knowing, everybody knows credit card, Bitcoins currently is very popular. Some other kind of articles can be used instead of money. In some countries, most of the transactions are realized via banking sectors, and the people are not using anymore the currency and coins, and they are using credit cards or Bitcoin, as you know, very popular. And currently, as the Musk declared, it is going to be devaluated and depreciated because of this transaction between the United States and China. China trying to reduce the carbon emissions, and if it is used the Bitcoins, then it is will not accept it, said. And from this point of view, some speculative actions and some political inspections will affecting and changing this paper market either. And the measures of the money is supposed to be evaluated and categorized as M0, M1, M2, M3, and M4. M1 is the currency and coins, and M2 is the currency and coins plus the deposits of the post offices, and M1 plus time deposits with the banking system is also included to the M3, and M4 is the M3 included with the all deposits with post office saving banks is categorized. And as you are understanding, between the post office and time deposits versus banks fixed deposits affecting and changing the amount of the capital in the system, just like the banks fixed deposits, post office time deposits are meant for those investors who want to deposit a lump sum for the fixed period of time. And from this point of view, fixed deposits become a little bit important, but deposits in the post is also very important, because you are having requiring deposit accounts as a similar to the banks, where you can invest fixed amount of monthly basis, and this is then the requiring deposit account. Fixed tenure for 5 years can be adjusted in the United States especially, and it is also important and affecting the amount of the capital which is deposited in the banking sector. And these deposits accumulate the money at an annual fixed rate of interest at 8% in the United States, and the interest is compounded on a quarterly basis. And the minimum investment in a post office for the requiring account is around 10%, and there is no prescribed upper limit for this post deposits. And for example, if you invest $100, let's say every month in 60 installments, you will earn a sum of let's say 7,289 after 5 years, if it is calculated as the future value. And as you are observing, this is becoming very important in the economy either, because you are using this post deposits as it is assumed to be an important reserve amount in the economy. And when we are looking to this graph, to this figure, you are observing the M1 is the demand deposit, as I mentioned to you, is included with the currency and coins, and the traveler checks and the other checkable deposits which is counted considerable important amount in the economy. Almost the currency amount is equally distributed. And when you are looking to the M2, the everything in M1 will be included, plus the saving deposits, small time deposits, money market mutual funds, and the few minor categories is included, which is around 4 billion some considered. And as you are understanding, we are mostly using for calculating the monetary value and estimating the amount of the capital by using these deposits in the banking sector. And it is important to know exactly what is the amount of these currencies in the system and what is the contribution of these deposits to the economy, whether it is affecting and reducing the amount of this capital in the system, the circulated capital in the system, especially in the banking sector, in the financial sector, or not. Therefore, there is a total amount of 1.5 trillion in the United States physical currency in circulation, and roughly 80% of this value comes from notes. And each year, 70% of the new bills, the printed money, is replaced with the existing in the circulation. Therefore, the US economy, which is heavily used in the most developing emerging economies and affecting the global market, having considerable importance and considerable influence to the other money markets and the other financial systems in the world. And special drawing rights, when we are looking to the special drawing rights, is or are these supplementary foreign currency reserve assets defined as maintained by the IMF, International Monetary Funds, and special drawing rights unit of account for the unit of account for the IMF and not as a currency per use in the system. And these represent claim to the currency held by the IMF member countries for which they may exchange. And these special drawing rights created in 1969 to supplement shortfall of preferred foreign exchange reserve assets, namely the gold and the US dollar, which is very heavily used at that time. You know, the gold standards and the impact to the global market. Probably if you research, you will understand. Probably I will give you one assignment regarding to these gold standards and the impact to the economy, for refreshing yourself to understand the impact of the gold standards in the global market, whether it is better to use the currency in the global market heavily and becomes a dominant position or not. Will give you information and clue about this system, which was not very popular after collapsed, after the appreciation of the dollar is collapsed, and it is probably giving you an information about the global currencies which is currently used, especially US dollar, the euro, and maybe UK pound heavily in the international transaction. Unfortunately, the yen is not popular, and the yuan is also not very popular in the international transactions. As you are understanding, the Chinese economy is the second best economy in the world, but are not used in the global market. And the time deposit is the deposit in the banking account that cannot be withdrawn before the set date. The time deposit is also like bonds you have, or stock papers, you have the limit for this maturity dates. Then you will then able to recreate or reuse again this in the system. And from this point of view, this is also important because you are restricting the amount of the capital in the circulation, and it is somehow contributing to the economy. When we are looking to this capital, the US total reserve is illustrated on the graphic. As you are observing, we have some amount of gold, which is around 11 billion probably stock paper in the economy from 2017 to 2021, and the special drawing rights, as I mentioned to you, is around 51 million somehow, or billion. and the reserve position is also given around 70 billion, and the foreign currency is 42, which is affecting and changing the US economy. And you are understanding almost twofold of this currency comprised from the gold stocks and the special drawing rights and the bank reserves, and some let's say 30% is the foreign currency in the US economy, which is in the many countries is almost similarly realized in many economies where they are using heavily this foreign currency, especially US dollar and gold and some euro comprise most of the economies foreign currency and foreign reserves. And due to this reason, if they are reducing this currency reserve, this capital in their reserve, they are exercising problem. They are creating some crisis and economical problems in the economy, because they have to put this foreign currency and foreign reserve into the banking system. Otherwise, they are exercising too much problem, because they are dealing and treating their transactions and their trade with these currencies. And if it is not sufficiently observed in the economy, create problem. And or if it is very heavily appreciated and increased in the economy, then the domestic currency will become depreciated and will become devaluated, and the inflation will then start to increase in the economy. And from this point of view, this distribution is important, especially in the from the foreign reserve system in the United States. And when we are looking to the case study that I am going to ask you for realizing for your country, you may note these questions for your assignments for combining with the reserve amount, and for increasing and enlarging the economy regarding to the reserve system. The amount of the money in your economy will be questioned with this study, with this essay, let's say, or case study. And you will then exercise and learn in few minutes the tools, the banking tools, the monetary tools, policy of the monetary system, the banking tools, the instruments of the economy, the financial system. And you will combine this together for sending me this homework as contribution to your, let's say, midterm. This will be evaluated around 10%. I will upgrade your results approximately 10%. You note this assignment, or you may find this video in the YouTube, Ergin Fikri Akalpler, and you can download it and see the assignment that I'm going to give you now. And then you will combine this with the policies, with the instruments in the central banks, how the central banks in your country realize their policy and they are controlling their economy and their financial system is going to be questioned to you, and you are going to analyze your country. I hope you are understand what I am expecting. You have to download this video after finishing or tomorrow maybe, and then you will see in the YouTube. Then you will then do this as an assignment. You got it? This will be your assignment. I am not going to upload this as an assignment, but you have to do this as an assignment for your contribution, for contributing to your midterm. Is it clear what you are doing? If you have any question,
Yes,
ask
sir.
me. Yes. Then let me finish this class, and I will refresh you again what to do. Okay, what you are going to do. Let me finish first this class, and then you will get more information, comprehensive information. After you are getting the information, then you will understand. Let's look to the Federal Reserve System. This is the central bank in the United States. The Federal Reserve System, so-called the FED, you are probably hearing this regularly in the media, in the social media, in the televisions, in the news. And this is then very important, let's say, institution, the Central Bank of the America, which is affecting and changing the global economy, because they are playing with these interest rates regularly, or they are staying intact for several months or years, and this will then increase and enlarge or decrease and reduce the amount of the dollar in the circulation, and the reports which is issued regularly is affecting very heavily the global markets and global economy. And from this point of view, every country trying to get these reports and analyze in regarding to their system, how it is going to affect and change their banking reserve and economy, whether it is depreciating or appreciating. Because if the dollar, regarding to these let's say reports, if it is the interest rate is increasing, then probably the dollar will become appreciated, because they are collecting the dollar back, and it will then appreciate and create some problems to the other economies. Or the wages, if in the United States wages increase, probably this will then affect and change the prices, and when the price goes up, then it is expected that the interest rate will also goes up. And this is then how it is affecting and changing the global economy, because if the market is affected and changed, then the global market is also affected. And this is then the reason why the FED results and FED decisions and reports become very important in the global market. It is designed to oversee the banking system. It regulates the quantity of money in the economy, and it is affecting, as I said, to the global market very heavily. FED was created in 1914 after a series of bank failures convinced Congress that the United States needs a central bank to ensure the health of the nation's bank system. This is the First World War, as you remember, started, and this then affecting and changing the banking sector in the United States either. The structure of the Federal Reserve System, when we are looking to the system, the Board of Governors and the regional Federal Reserve Banks and the Federal Open Market Committee affecting and changing the decisions of the economy of this institution. And the FED's organization is in the Board of Governors, which have 7 members appointed by the President, confirmed by the Senate. And from this point of view, you are understanding the President of the United States affecting everything when they are coming to the position. And it is having considerable important role for the economy either, if they are having from their economical and political aspects, there will be probably no problem. But if there is the other Democrats or let's say Republicans, then they will then have different aspects and different applications, and then they will create some problems to the economy either. Because the Federal Reserve System or the central bank is the independent organ of the economy, and the government is not easily intervene to this institution. But from this point of view, you are probably understanding, since the president appointed this person, the president, then it is becoming somehow influenced from the governmental policies and governmental applications and measures and regulations. And this is then very important to know that the politics always in the issue. Among the 7 members, the most important is the chairman. The chairman directs the FED staff, presides over board meetings, and testifies about FED policies in front of the congressional committees. And the Board of Governors, 7 members, as I mentioned to you, appointed by the President and confirmed by the Senate, and for 14 years. So you are understanding, the President probably elected by the other governments, and it is become dependent to the newly, because you know, this is a very long period of time, and it is affecting probably the economy heavily. If it is not any conflict or any problem between these institutions and governments. President appoint the member of chairman to serve as 4 years, appointed. And the Federal Reserve System is made up of the Federal Reserve Board in Washington, and 12 regional Federal Reserve Banks is also included into this. And Federal Reserve Banks, 12 district banks is observed, which is affecting and changing the restrictions and applications. And 9 directors, 3 appointed by the Board of Governors, and 6 are elected by the commercial banks in the district. and the directors appointing the district president, which is approved by the board of governors. And when we are looking here, we are giving this because it is affecting the global market, and I just want to give you just an overview because it is in the book. Probably you are asking why we are giving this Federal Reserve System, but it is affecting, as I mentioned to you, the whole global market and all economies. And from this point of view, you may wish to know how it is realized. As you are observing here, the Federal Reserve districts represented on the circles, and the Federal Reserve Bank cities represented with the pointed, and Board of Governors of the Federal Reserve is represented with the small circles, which is given in this map. And as you are observing, Boston, New York, Philadelphia, Washington, and Richmond are the small, and the rest, the Kansas, San Francisco, Minnesota, and Cleveland, and Dallas are becoming eligible for the Board of Governors, and the other largers are the Federal Reserve districts, which is affecting and changing the economy. The Fed's organizations, when we are looking, the Federal Reserve Banks, the New York Fed implements some of the Fed's most important policy decisions, and the Federal Open Market Committee, of which affecting and changing most of the political applications and instruments, serve as the main policymaker, as I mentioned to you, organ of the Federal Reserve System, and meets approximately every 6 weeks to review the economy. And the Federal Open Market Committee is made up of the following voting members: the chairman and the 6 members of the Board of Governors, and president of the Federal Reserve Bank of New York, and the presidents of the other regions' Federal Reserve Banks for vote 1 yearly voting basis are appointed and doing the necessary policy measures. And monetary policy is conducted by the Federal Open Market Committee, and monetary policy is the setting of the money policy by policy makers in the central banks, and money supply refers to the quantity of money available in the economy. And from this point of view, you are understanding the issuing policy and issuing money to the market is mostly dependent to this institution and these people's decisions. 3 primary functions of the Federal Reserve System, so-called the central bank, regulates the banks to ensure they follow federal law intended to promote safe and sound banking practices, acts as a banks, making loans to banks, and as a lender of the last resort, which means the last organ to asking for the money for borrowing or for lending. The money market is the highest organ, and conducts monetary policy by controlling the money supply. And the open market operations, the money supply is the quantity of money available in the economy, and the primary way in which the Fed changes the money supply is through open market operations. As I mentioned to you, there are 3 important instruments for affecting and changing the economy. I'm going to introduce you in a few minutes. The Fed purchases and sell US government bonds and affect the economy by using this monetary policy instruments for the central banks. The first one is the open market operations, so-called the OMO, refers to the central bank practices of buying and selling primarily securities, bond stock papers on the open market in order to regulate the supply of money that is on the reserves in the banks. And expansionary money policy and contractionary money policy are the important policy measures for regulating the money in the system. The open market operation is very important for controlling the amount of the money, so-called the money supply in the system. If excessive money supply observed in the system, we are using the expansionary money policy. So we are using the contractionary money policy. If there is excessive money supply, then you are going to reduce the money by buying the bonds, by selling the bonds in the system. And open market operation, to increase the money supply, the Fed buys governments bonds from the public, as I mentioned to you. this is contractionary. Sorry, this is contraction, this is expansionary, and decrease the money supply. The Fed sells the government's bonds to the public. This is then the expansionary, because it is you are going to decrease the amount of the money. Then you're gonna sell the bonds to the market to collect the money from the market. And let's give some more comprehensive explanation for this contractionary and expansionary money policy. Contractionary money policy, as I mentioned to you, the central bank sell the bonds, or the markets sell the bonds. Let's look at these graphics. We are supposing there is inflationary gap in the market. This means you have less money in the system. As you are observing, the long run aggregate supply and the short run aggregate supply curve is given here. Of course, you don't know these things, but just graphically, I'm going to give you. In the following lectures, I will give you this. But for now on, you are understanding there is a long run aggregate supply curve which is not affected from the price changes. And this means then you have to do something for controlling the money supply. And from this point of view, if there is a less money in the system, then you have to do for reducing the amount, because contractionary money policy is the means that you are reducing the money. And when you are looking to the second graphic, when the long run aggregate supply curve is applied and reduce the amount of the money, this will then restrict the amount of the capital in the system, and this will then reduce the money and enlarge in the system, where in the banking sector is collecting this. Therefore, contractionary money policy is somehow reducing the money in the system. And as you are observing here on the third graphic, decreasing the money supply from S1 to S2, because some of the bonds will be sold into the system and collect the money to the banking sector, and results of this distributed money and distribution and circulation money in the system will be reduced, and S1 goes to S2, which is the money supply is reduced. And as you are observing in the short run, the exchange rate rises and increase the economy to the D1 to the D2. The quantity of dollars per period is supposed to be enlarged in the system, but the money supply is reduced from S1 to S2, as you are observing on the fourth panel. And as you understanding from these graphics, the contractionary money policy is the reduction of the money supply in the system. Therefore, you are selling the bonds to the system for collecting the excessive supply or excessive money in the economy and directing it to the banking sector. This is how it is realized. The central bank realized this function with this contractionary. And also expansionary is also used for controlling the money supply. When the central bank, there is a problem in the economy, then it is required to distribute or pump up the money to the system for enlarging the money. Therefore, then the central bank will buy some bonds from the system, and as you are observing, it is shifting the money supply, aggregate demand to the upper level, and the money supply will become enlarged in the system because the government and the central bank realize this action, buying the bonds from the banks and distribute some capital to the system, and this will then enlarge the economy. The money supply in the system will then enlarge. And as you are observing here, results of this, it is expected that the price is going from P1 to P2 on the second graphic is illustrated. And from this point of view, results of this action, the money supply is enlarging at the third graphic, which is increasing S1 to S2. Now the money supply is enlarged, and results of these three graphics, the equilibrium, so-called the aggregate supply and aggregate demand in the economy. The graphic represents the amount of the dollar in the system and the exchange rate, which is enlarged and increased to the S1 to S2 in the graphic, and the amount of the supply now is expected to reduce and become to D1 to D2. This is realized results of this expansionary money policy in the, let's say, central bank activities. These are a little bit heavy for you, but you are just getting the knowledge, this expansionary, contractionary money policies. But in the following years, if we are meeting again, we will give you with the ISLN liquidity money saving investment graphics and applications, then you will understand better with more comprehensive applications, with more, let's say, calculations. You will see how it is affecting and changing the economy. And when we are looking to the money supply, the banks can influence the quantity of demand deposits in the economy, and the money supply is affected from this point of view, as you are observing in the former graphics that I have represented to you. The monetary policy tools are continuing, and then we are using the second instrument, and we are introducing the second instrument, which is the discount rate. This is almost similar to the interest rate, the so-called real interest rate. As much as you are increasing the discount rate, this will create problem and enlarge the saving capital, but restrict the investment capital. And from this point of view, it is parallelly realized with the interest rate that I'm going to introduce to you. And the discount rate is the rate that the central bank charge their members banks to borrow at its discount rate, because it's higher than the central bank funds rate, and banks only use this if they can't borrow funds from other banks. And from this point of view, as I mentioned to you, this central bank tools is also used for the banking sector. When they are in need for getting some capital, they will be reorganized, reduce the discount rate or increase the discount rate for managing this amount of the capital. If it is in the banking sector is too much, then this will then increase the banking rate, not borrowing easily. And the opposite is also realized for decreasing the discount rate, will be enlarged and increase the amount of the capital in the banking sector. Therefore, this is also similarly realized as we are understanding in the banking sector. If the interest rate is high, you are prepared to invest to the banking sector. You are prepared to save to the banking account more capital, because you will get more capital, more interest rate. And if it is opposite realized, then you will give up saving because they are not giving high interest rate, and this will then reduce your promotion, and this will not promote you to save more capital into the system. We are giving here a graphic. As you are observing here, the interest rate and the quantity of money is represented for the discount rate. As I mentioned to you, if the discount rate, so-called the interest rate, is reduced, you are observing the saving capital is enlarged, but the demand is not parallelly realized, which is not illustrated here. The saving capital is reduced here because the people who wants to save is reduced, but the amount of the capital in the system, so-called in the banking sector, is enlarged, because this capital is not directed to the market, but is directed to the banking sector. And if the interest rate, so-called the discount rate, is reduced, the people, or so-called the institutions, banking sector, who wants to use this central bank offer or the reserve, then is enlarging. As you are observing here, is moving from S1 to S2. But in the banking sector is opposite realized for the investors, because now we are not talking about the investors and the savers, but we are talking about the bankers who are wishing to enlarge and increase their capital in their banking institutions, in their intermediaries. And from this point of view, if the central bank reduce the interest rate, this will enlarge the amount of the capital in the banking sector. This is enough, I think, for you. And the other tool is the reserve requirement, so-called the reserve ratio. And the reserve ratio is the money bank, is referred to the money banks must keep on hand overnight. They can either keep the reserve in their wallets or at the central bank. A low reserve requirement allow banks to lend more of their deposits. It's expansionary because it creates credit. As I mentioned to you, if the reserve ratio is low, it is again positively affecting the banking sector and letting the people to enlarge, especially the institutions, the banking sectors, to enlarge their capital holding in their hands. But on the other side, if it is opposite, realize if it is high, if the reserve requirement or ratio is high, this will then create a contractionary impact and it gives bank less money to lend. Therefore, if reserve ratio is high, if it is 30% reserve ratio is force majeure, not giving to the people, then this will then restrict the amount of the money which is going to be distributed to the people. The credit which will be distributed to the people will become less, isn't it? Because if set 50% reserve ratio, then the rest of the 50% can be distributed, but 50% must be held in the banking sector as a reserve requirement, as a reserve ratio. Similarly, realize this for the central banks. If it is high, this will then means you can get more, but if it is less, then you can get more, because you can get more. I mean, cannot and can, you are understanding. If it is high, you cannot. If it is low, you can, because it is allowing you to get more capital, because you don't have to hold too much money into the banking sector. The reserve ratio is represented on the graphic as you are observing here. If it is low here, you are moving from MS1 to MS2, money supplied going to enlarge to quantity of money 2, and this is then realized because the reserve ratio is low. And this is realized exactly the same for the discount rate or for the banking sector, where you are wishing to enlarge and increase the investment amount in the economy, or when you are using this discount rate. Similarly, it is affecting the amount of the capital which is going to be used by the savers or by the banking sectors, which is going to enlarge and increase in this direction for the banking sector as a reserve ratio. If it is high, then the amount of the capital, as you are observing here, is high, but when it is low, then it is reducing the amount of the capital in the banking sector. And the money supply, when you are observing from these instruments, is going to be controlled by the central bank and the banking sector. And if it is high interest is deserved and realized, this will create strictly money policy and create a contractionary impact to the economy and reduce the amount of the capital in the system. And this is then positively affecting the amount of the money and its appreciation is realized. But if there is too much money in the system, this will then inflation. If the money is too much in the system, it's cause price increase, and it is affecting negatively the currency, and it is causing some devaluation, and it is causing some inflation and depreciation to the economy, because the currency will become depreciated, and it is reducing the impact to the economy, because when the currency is depreciated, it is not good for the economy. Some positive impacts is observed, especially for the exportation of the goods, but it is not good for the economy. And in fractional reserve banking system, banks hold a fraction of the money deposited as reserve and lend out to the rest. And from this point of view, the reserve ratio is the fraction of deposits that's held as reserve. And when a bank makes a loan from its reserve, the money supply increases, and the money supply is affected by the amount deposited in banks, and the amount the bank loans and deposits in a bank are recorded as both assets and liabilities, and the fraction of total deposits that a bank has to keep as reserve is called by the reserve ratio, and loans become as an asset to the banking sector. And from this point of view, you are understanding these three instruments, especially the open market operations, affecting heavily the money in the market and control the money heavily. And when we are summarizing these three policies, the open market operation as a cash or repo basis, the central bank buys securities and thereby inject base money into the financial system. And the central bank, this is then, of course, when it is buying is contractionary, and the central bank sells securities and thereby the withdraw base money from the financial system. Then these are affecting and changing the economy. when central banks buy the securities from the banking sector, this will pump up the money and it is expansionary. When it sells the securities, so-called the bonds, this will then contractionary money policy for the economy. And when we are looking discount rate, low discount rate encourages banks to borrow from the central bank and lend to the households and others. And high discount rate disused banks to borrow from the central bank and lend to the households and for the corporates. And the reserve requirements, high reserve requirements or reserve ratio, constrain banks to lend money by forcing them to hold more cash. And low reserve ratio encourages banks to lend money by forcing them to hold more cash. The other one is not necessary for you. Therefore, these three policies can be summarized with this graphic table. And then we are looking to the ISLM for shortly application. You know, the ISLM is the investment, saving, and liquidity money. I'm going to give you a brief description about this issue either for becoming a little bit familiar. The saving liquidity preference money supply model is the ISLM, as I mentioned to you. Explain the relationship between the interest rate and the output in the goods markets. And advanced version of ISLM is aggregate demand and aggregate supply model. It represents the aggregate supply and demand of financial, labor, and goods markets that we are mostly concentrating to the goods market and the money market. And here we will just stick to the commonly used or known ISLM model to show you the basic mechanism. And let's look up to this table before going to the graphic. It shows the relationship between output and economic growth, so-called the interest rate and the Y, the production capacity is represented on the graphic, and this relationship takes place in the goods and the service market, so-called the money markets and the financial markets. The ISLM curve is represented and illustrated on the graphic. As you are observing, it is the Y-axis interest rate, and on the X-axis it is the production, so-called the output, and on the proportional relationship, the ISLM curve is represented. The liquidity money is proportionally related with the interest rate. As much as you are increasing the interest rate, the amount of money is supposed to be enlarged and increased, and the liquidity, and the vice versa is realized for the investment saving. As much as the interest rate is reduced, the investment and which is the similarly saving is supposed to be reduced, because investment and the possible amount of the capital is expected to become lesser when the interest rate high, and when the interest rate is low, the amount of the credit which is going to be used by the investors is supposed to be enlarged, and results of this production is also enlarging. And this graphic is represented regarding to this aspect. And the ISLM curve is the important contributor for the financial system and for the money market. And the IS is the investment saving, and it is downward sloping, as you are observing on the graphic. It is downward sloping. As much as I said to you, interest rate is going up, the output and the investment is reduced. And when the investment is reduced, the expected output and the production operation process is restricted and realized lower level. And as much as the interest rate is going down, then it is expected that the investment and the amount of the production or produced goods and services enlarge. And then you are looking to the LM curve, where the liquidity preferences is the money supply is represented. As output growth, interest rate rises, and intuitively, when output grows, demand for liquidity increases and loans increases, which rises interest rates. And therefore, LM is an upward sloping curve, which is the proportionally with the interest rate. When you are looking to the graphic again, you are observing the LM curve is proportionally with the interest rate. As much as you are increasing the interest rate, the liquidity and the amount of the money in the system, especially in the financial system, is enlarged and increased. When we are looking at the Keynesian model, the components of the Keynesian, you remember, is the consumption, investment, governmental expenditures, and the next export. You know these things, I think. I have mentioned to you in the former classes. And when you are looking to this model, the Y is the output, so-called the GDP, and C is the consumption, I is the investment, G is the governmental expenditure, and X is the export, and M is the import, and the difference between this X minus M is the net export, which is the mostly giving us the current account deficit. Of course, we are using the other transactions, but mostly the difference between the export and import creating the current account deficit. If there is a deficit in the economy, it means we have more import and less export. If there is a surplus in the economy, it means there is more export and less import, which is in many economies in the global platform exercising the deficit, because the importation is very high and exportation is always less than the import, and results of this we are exercising the deficit. The current account deficit and the trade deficit is always realized. From this point of view, it is important to note in closed economy, when we are excluding this, then the trade transactions is excluded, then you can simplify the model with the C plus I plus G, and you can then create the model very easily when you are excluding these transactions from the outside. When we are questioning what factors affects and influence the IS and LM curves, the monetary policy is the first runner, as you are understanding from the former explanations, refers the actions of central bank that determine the quantity and price interest rate of the money supply, and the fiscal policy refer to the government revenue, so-called the tax, and the expenditures is affecting and changing the economy, as much as the tax policy, which is enlarging and increasing the amount of the capital in the hands of the government, is positively affecting and increasing the economy. And from this point of view, I have to give you one more information. If the collected tax amount is higher than the governmental expenditures, then the amount of the capital becomes positive, and the surplus of the government is affecting and increasing this economy, and the current account is becoming surplus. And if it is opposite, when the collected tax is less than the expenditures, then this means there is a deficit in the economy, and it is then not good for the economy. And when these are equal, then there is no problem for the economy. They are in balance. And the fiscal policy always trying to collect more taxes for increasing and enlarging the governmental, let's say, spendings and governmental applications. But as I'm going to give you in the following classes, you will see if the tax rate and the tax amount is very high, more than 15, 20, this is not very good for the economy. Neither the government collecting this capital properly, nor the producer surplus and the government and the consumer surplus and consumer welfare is negatively affected and negatively influenced from this higher tax policies. Therefore, reasonable tax policy must be applied for the economy, for balancing the economy in the desired level. When we are looking to these shifts on the IS and LM, which I am not going to put on the graphic because it is not necessary for you, but you have to know if there is an expansionary policy, it is expected that the fiscal policy affecting the governmental expenditures and decrease the tax, and the monetary policy, from the monetary policy aspect, if there is an expansionary policy affected, then an increase in the money supply is expected, and the decrease in the reserve ratio is realized. And contractionary money policy affecting the fiscal policy, if the governmental spending is decreased, and the contractionary policy is affecting the fiscal policy, the tax policy is expected to increase, because you are collecting the capital much more, because you are reducing the amount of the capital in the system, and you can put the tax, for example, to the economy, to some products or to some articles. then increase the amount of the collected capital and reduce the amount of the money in the system. If there is a sufficient capital in the system which is circulated, this kind of actions is observed. And if the monetary policy is subjected, then this contractionary policy is decreasing the money supply and increasing the reserve ratio in the economy, because contractionary money policy, as I said to you, is the means that you are collecting the capital to the banking sector, to the central bank level, and this will then enlarge the reserve ratio to the system. If it is reserve ratio is increased, vice versa is also realized. If the reserve ratio is high, then this will then affect the monetary policy in the opposite direction and cause some contractionary impact to the economy. The ISLM shifts when we are looking to the fiscal policy, which is 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 subjected here. The expansionary policy cause shift to the rightward, and the monetary policy, if it is subjected, so-called the LM, shift to the rightward bilaterally. And the contractionary policy for the IS, which is affected, shift to the leftward, and the contractionary policy affect the money policy, so-called the LM, shift to the leftward, which can be illustrated on the graphic. But you just imagine the graphic that I have given to you, this IS and LM, then you can draw it on the graphic, or you will wait a little bit, because in the following chapters we will exercise this IS and LM a little bit more comprehensive if we have enough time. And the money creation and the fractional reserve banking is subjected here. The T account is shown to you. The accept the so-called the banking account is accepting deposits, keep a portion as a reserve, and they lend out the rest of the capital which is given them. And it is assumed the reserve ratio around 10% is enough for collecting this money creation into the system. But if there is a higher than this 10%, is also possible, 15% is also observed in the banking sector, which is creating this banking account to the system. And when you are looking to this bill on the table, the assets and the liabilities, the reserve is supposed to be $10 or $10 million, and the loans is 90%, and the deposit supposed to be 100, and the total assets is supposed to be equalized between the banking sector. For this given example, if this reserve is supposed to be 10% is assumed. When one bank loans money, that the money is generally deposited into the another bank, this creates more deposits and more reserve to the bank for lending out. And when a bank makes a loan from its reserve, the money supply is increased, as I mentioned to you, because it is expected to increase and enlarge if it is set high, and if it is low, then this will then create negative effects, and this will then reduce it. When we are looking to the money multiplier that I am going to give you in the following chapter, comprehensive applications with calculations, you will get more information about the impact to the economy with calculations. I will give you some simplest models, this y c plus I plus g plus nx, and to see how it is affecting and changing this multiplier, so-called the R, how it is affecting and changing the consumption, investment, and the GDP. You will see on a simplest application. This multiplier is the amount of money that the banking system generates with each dollar of reserves. And as you are observing here, the reserve is supposed to be 10% and $10, and the loans is 90, and the deposit is 100, as it is given, let's say in dollar, and in not million and in billion. And the total asset is supposed to be 100 billion, and the total liabilities is also 100 billion. And the Second National Bank, when you are looking to the reserve ratio after this used as a multiplier effect, is going to be on this 10%, is again 10% interest is counted and cuts is realized, and this will then 9, then the loans will become 81, and the total asset becomes 90, and the rest is going to be again 90, because this is then the double let's say discount realized for this banking sector. And as you are observing, it is reducing the amount of the liability, but it is at least creating some positive effects to the economy if there is a necessary application for reducing the amount of the capital into the system. You are observing here the deposits directed to the second national bank from the first, and this will then probably counted again with 9%, which is 10%, $9 so-called, or $9 billion from these given deposits to the second national bank, and this will then reduce the amount of the total loans which is going to be used, but the total asset is again 90 billion, and equally liabilities realized in the second nation's bank or national banks. Therefore, the money supply is $190 or $190 billion can be estimated. The money multiplier is the reciprocal of the reserve ratio. M is equal to, there is a equal sign, but is not illustrated. M is equal to 1 over R, and with a reserve requirement, if R is 20%, then which is 1 over 5, then the multiplier is 5, because 1 over 5 is 5. Then he's going to estimate it in a given example, which we are going to use in the following lesson with comprehensive applications. The FIT has three important monetary toolbox, as I mentioned to you. Once again, the open market operations, changing the reserve requirements, and the changing the discount rate can be used with these instruments which is introduced to you. And the open market operations, as I mentioned to you, was the government which is going to use the expansionary and contractionary money policy. And when the FIT buy government bonds, the money supply increase and the money supply decrease. This is then the contractionary. When this FIT sells government bonds, these are realized for the open market operations. And the reserve requirements, as I mentioned to you, is the influencer for the money supply by using these percentages, which is given to you on the table, is going to be discounted by the central bank again. And reserve requirement, if it is high, it is increasing, sorry, it is decreasing the amount of the capital. And if it is low, it is increasing. And the reserve ratio, as it is given here, increasing the reserve requirement, decrease the money supply, and decreasing the reserve requirement, increase the money supply, as I mentioned to you, because it gives the amount of the money, it's pump up the money to the system. And the changing the discount rate, again, if the increasing the discount rate decrease the money supply, and if decreasing the discount rate, it will then increase the money supply, as it is observed in the interest rate, so-called nominal interest rate. And if it's control the money supply is not precise, because you don't know the speculations and you don't know how it is affecting and changing the money market. And it must wrestle the two problems that arise due to fractional reserve banking. The FIT does not control the amount of the money that households choose to hold as deposits in the bank, because this is the considerable important proportion of the economy. And the FIT does not control the amount of the money that bankers choose to lend, because they are own decisions. They are the own decisions. Okay, this was the summary. This was this lecture. I mostly give you the theoretical part for this class. And next lecture, I will probably give you the application. Please be here, because you will get some calculations and you will get better information about this, let's say, chapters. And then I will give you the production function, because I want to give you, as you are attending to this class, the applications also for being able to understand the impact to the economy with these numbers, with these models. And it is better to be here next lecture. The term, I will give you a brief information also for the assignment that you are going to do, but let's summarize this quickly. The terms money refers to assets that people regularly use to buy goods and services, and money serves three functions in an economy: as a medium of exchange, a unit of account, and store value we introduced to you. And commodity money is the money that has instinctive value, and fiat money is the money that without instinctive value. The Federal Reserve, the central bank of the United States or any country, regulates the monetary system in any country, you know, and it controls the money supply through open market operations, especially expansionary and contractionary money policy, and reserve ratio and the discount rate are the three important instruments of the monetary system for controlling the money in the economy. And when bank loans out their deposits, they increase the quantity of money in the economy. And because Fed cannot control the amount of bankers choose to lend or the amount households choose to deposit in the banks, the Fed's control of this money supply is imperfect. And from this point of view, we are coming to the end of this class. And I have to give you information about the assignment that you are going to do. It will be in this video that you are going to read and analyze the instruments you are going to compare with your country's central bank applications. How is the, you can take notes or you can download this video and learn, listen again and do your assignment. You have to write the monetary tools of the central bank. You have to define me the monetary tools and then compare with your country the monetary instruments. What are the instruments in your country they are using for controlling the money market? You can use graphical illustration. You can use tables of your countries, at least 10 years data. You can give me their assets, the foreign assets, the domestic currency, the amount of the gold in your country, how much is it and how they are affecting and changing the economy. What is the inflation rate, how it is affecting and changing, and how they are using these instruments for controlling the economy. You can introduce to me whether the expansionary and contractionary money policies is effective for controlling the inflation, for controlling the money market, so-called the money supply, is important for me to compare with your country's economy and country's central bank. I hope you got the information, what you are going to do for this class. If not, then you ask me question. I will repeat my introduction to you, my instruction to you. If not, then I will finish the class.
Sir, I have questions. Can you please help us put this on our assignment page, then we can go there and
you want assignment? You want as an assignment? Okay, I can do it. Okay, I can send you an assignment. I can put to the system as an assignment. Then you do it. Okay. Okay, but
yes.
Please download this to Ergin Fikri Akalber in YouTube and read once again. Okay, listen once again because it will gives you comprehensive information. Then you will do your assignment better, because it is important to do this and understand this a little bit, because its theoretical part is important for you for giving me the correct information. Okay, then I will put you the assignment also into the system. If you don't mind, I'm gonna finish this class for today. If you don't have any question. Okay?
Okay, sir. Thank you.
Okay. See you then next week. Bye-bye.
Bye-bye.